Hello value investors, thank you for joining me. Today I want to talk about Zynga and what is attractive about Zynga and why I'm kind of not so enthused and not willing to take a position here. If you haven't done so already, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, with a balanced argument for the stocks I own. Right now there's some good stocks that I'm kind of looking at, and if you do a free trial, you can cancel anytime before 14 days. No harm, no foul. So, Zynga puts out this guidance for 2021 of growing at 38% year over year. That's a slight deceleration from last year, but more importantly, the guidance for 2022 is pointing to mid double digits. So you got a company that's growing at a certain rate, and then it's decelerating, and the guidance for the next year is even slower. So this is something that you want to kind of bear in mind. So we're going to dissect why is that drop in the deceleration coming out for next year. So here's the thing. Zynga is an incredibly acquisitive company. So if you look at its cash flow, you have to bear in mind that below that cash flow line, yes, the company appears to have the prospects of being a strong cash flow generator, but that's because it has a long history of acquiring different developing companies. So if you look at cash flow from investing activities, you can see here in the illustration that there's a certain amount that is even in 2021, in the last quarter of Q1, from acquisitions. So you remember in 2020 they had a lot of acquisitions. They made the acquisition of Rolik and they made the acquisition of Peak. So those two acquisitions were very expensive acquisitions that boosted its growth rates from 2021 at the back end, from 2020 at the back end towards 2021. So anytime a company makes substantial acquisitions, that's obviously going to move the needle up quite a lot. But if you remember that when it comes to lapping that, the company is going to have some very strong comps to come up against. So that's part of the reason why the company is going to be decelerating next year. Another thing that I want to talk about is that Zynga's management actually has quite a lot of skin in the game here. They have approximately 8.3% of the stock. So that's approximately 900 million worth of equity on a company that trades at approximately 12 billion. So they are very much aligned with the prospects of all shareholders. So they are very motivated to really drive shareholder value. I'm just not 100% convinced that they're able to, but there is a lot of skin in the game, so that can play out quite positively. So the company is guiding for 450 million of EBITDA this year, but that's after adding back quite a lot of different expenses, such as there's a contingent consideration down to the liabilities that they've made from the acquisitions. So that's an estimate, but that's still a real cost. Obviously depreciation and amortization is added back there. I'm not even talking about stock-based compensation, but you just have to bear in mind, is it really kind of growing at a rate that is worthwhile paying approximately 27 times forward EBITDA? That's quite a punchy value. So although it looks cheap on the surface, as it trades for approximately 4 times sales, it's on this below the surface. When we get into the EBITDA, we have to consider that a lot of that EBITDA is being improved year over year from 2020 because it's boosted through acquisitions. If you look at this graph here, so the average daily active user booking number is kind of flattish to falling, so it's not really driving on a per user basis, not really driving that monetization sufficiently well. So yes, on the one hand the EBITDA looks better, but on a per user basis it's not really kind of moving in towards the up and to the right that people want to see. So yes, it's kind of complicated. Is it really worthwhile? On the other hand, I think that the stock is kind of an attractive level. So I kind of was thinking about this quite a bit. I did kind of spend a bit of time looking at this, but unless the company can really show that it has organic prospects of moving forward and generating stable cash flow, I think that I'm just going to give this one a miss. So we talked about its revenue growth rates looking quite strong and how it decelerates going into next year. We talked about its acquisition and whether or not the company is bolstering its revenue growth rates on the back of substantial acquisitions. And finally, we talked about management having a lot of skin in the game and being quite motivated to drive shareholder value. So as always, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why. See you soon.